In the final hours before Lehman Brothers filed for bankruptcy on September 15, 2008, the world's financial system faced a terrifying question. What happens when banks stop trusting one another? Inside offices in New York, the firm was no longer fighting only for survival. It was fighting against the sudden belief that its assets might be worth far less than its records claimed. For years, banks had lent money to one another every day, often for only a few hours or days at a time. That routine depended on trust. Now, as Lehman approached collapse, lenders began holding back their cash, unsure which balance sheets were safe and which ones were hiding losses. The danger was not simply that one company would disappear, it was that confidence itself could vanish. Lehman Brothers was an investment bank, a powerful financial company that helped buy, sell, and finance large pools of investments. It connected people and institutions that needed money with those looking for somewhere to invest it. Its business reached far beyond one office or one group of traders. Lehman financed companies, worked with other banks, helped home builders raise money, and handled investments for major institutions around the world. When Lehman failed, the losses could travel through those connections. A payment might be delayed, a loan might be withdrawn, or an investment once treated as safe might suddenly become impossible to sell. At the center of Lehman's rise was Richard Fuld, its longtime leader. Under Fuld, the firm pushed to become larger and compete with the biggest names in finance. Growth was treated as proof of strength, and every new deal brought the promise of greater profits and greater influence. That drive created a culture built on speed, size, and confidence. Lehman expanded even when the risks were becoming harder to measure. Inside a company rewarded for winning, slowing down could look like weakness, while admitting danger could threaten careers, bonuses, and the firm's standing on Wall Street. Lehman's deepest exposure came from the United States housing boom. The firm helped create, buy, sell, and hold mortgage-backed securities. These were investments built from home loans, with payments from many mortgages bundled together and sold to investors. The process made housing debt look easy to move and easy to finance. A home loan could pass from a lender to Lehman, from Lehman to another investor, and then into a larger financial package held by institutions far from the original borrower. As long as home prices kept rising and payments kept coming, the chain appeared strong. But the hidden danger was not just one bad home loan. It was the belief that thousands of housing loans could remain nearly reliable at the same time. That belief treated a shared risk as if it were safely spread out, even though falling home prices could damage many borrowers and many investments together. When housing prices began to fall, mortgage-backed securities became harder to value and harder to sell. Buyers questioned what those investments were really worth, while lenders questioned the assets Lehman offered as security. The numbers on paper had not yet disappeared, but the trust that gave those numbers power was already breaking apart. Lehman's losses were made larger by leverage, the use of borrowed money to control investments worth far more than the firm's own capital. During the housing boom, this made success look enormous. A small rise in the value of its holdings could produce a large gain because Lehman had placed so much borrowed money behind each investment, but leverage worked in both directions. When home prices fell and mortgage investments lost value, Lehman did not lose only the money it owned. It also faced the debt used to buy those investments. The more the assets declined, the less protection remained between a market loss and a direct threat to the firm's survival. Below those numbers were families who had taken out loans to buy homes they believed would remain safe stores of value. Some lost their jobs and missed payments. Others watched their homes fall below the amount they owed, leaving them trapped between a shrinking property and an unchanged debt. The securities built from those loans carried the weight of these private disasters, even when the people trading them never saw the homes involved. Inside Lehman, the pressure moved through conference rooms, trading desks, and offices where employees understood that the firm's size offered no shelter if confidence disappeared. Careers, savings, and family plans were tied to a company whose balance sheet was becoming harder to trust. The crisis was no longer only about distant borrowers or abstract investments. It was reaching everyone connected to the chain. Lehman also depended on a form of short-term borrowing known as a repo, short for repurchase agreement. In simple terms, the firm gave securities to a lender in exchange for cash, then promised to buy those securities back soon, often within days. The arrangement worked like a very short loan secured by assets. This mattered because Lehman needed that cash to keep operating. It used borrowed funds to hold and trade large amounts of mortgage-related investments, but those funds had to be renewed again and again. If lenders began to doubt the value of the securities or the strength of the firm, they could demand more protection, refuse to renew the loan, or both. The problem was no longer just bad mortgages. It was the constant need to prove day after day that Lehman could still raise cash. Then came Repo 105, an accounting method that changed how some of these transactions appeared in financial reports. For a short time, Lehman treated certain transactions as sales rather than ordinary borrowing. That allowed assets to be moved off the reported balance sheet before a reporting date, while the firm received cash in return. The result was a cleaner-looking picture on paper. The reported amount of debt and risky assets could be reduced, making the firm appear less heavily borrowed than it truly was at that moment. The assets were not permanently gone, and the risk had not vanished. The appearance had changed, but the underlying exposure remained. Repo 105 could alter a report, but it could not create lasting safety. Once the assets returned, the same pressures returned with them, and markets did not judge Lehman only by its scheduled reports. Lenders watched its holdings in real time, asking what those assets might actually sell for and how much cash the firm could raise before its next payment came due. That was the limit of any accounting appearance. A balance sheet could look stronger for a few days, but it could not force a lender to renew a loan. As doubts spread about Lehman's real estate losses, its heavy borrowing, and the way its figures had been presented, the firm's room to maneuver narrowed until even a small loss of funding could become fatal. The danger had moved beyond bad mortgages. It had entered the space between institutions, where every bank watched every other bank for signs of weakness. A lender did not need proof that Lehman was already empty. It only needed to fear that another lender might refuse to provide cash the next morning. That fear could reinforce itself. If one lender pulled back, others saw the withdrawal as evidence of hidden danger and pulled back too. Soon, even firms with valuable assets could face a crisis, because assets that could not be sold quickly could not pay bills due that day. Trust had become a form of funding, and trust was disappearing. The rescue of Bear Stearns in March 2008 had shown officials how quickly one large financial firm could threaten the wider system. Bear Stearns had been pushed toward collapse after lenders and clients lost confidence, and JP Chase acquired it with government support. The rescue reduced an immediate danger, but it also revealed how fragile the market had become. It changed expectations in two opposite ways. Some believed the government would step in whenever a major firm was at risk. Others feared that public support could not continue without limit. Lehman now stood inside that uncertainty, large enough to matter, but not certain enough to receive the same treatment as Bear Stearns. During the final weekend before its collapse, officials and financial leaders searched for a private solution. The effort centered on finding a buyer willing to take control of Lehman or its most valuable operations, but any buyer would have had to accept unclear losses tied to real estate, along with the firm's urgent need for daily funding. The problem was not only the size of Lehman's assets. It was the fear that those assets were worth less than the company claimed, and that the losses would become the buyer's burden. A rescue would also have required confidence from other banks, whose own balance sheets were already under suspicion. The search continued, but the number of acceptable paths narrowed by the hour. Lehman depended on short-term lenders to renew its repo funding again and again. Those loans were secured by securities, but the lenders could decide that the securities were no longer safe enough. Doubts about mortgage-backed assets, heavy borrowing, and the firm's reported figures made that support harder to renew. When fresh cash stopped arriving, the machinery failed quickly. Lehman still had offices, employees, trading positions, and assets, but it could not meet all of the immediate demands placed on it. A firm can survive losses over time. It cannot survive when creditors demand payment and no one will lend it enough money to continue. On September 15, 2008, Lehman Brothers entered bankruptcy. It was not just the failure of a famous investment bank. It was a public signal that the crisis had crossed a terrifying line, one where a major institution could vanish from the financial system almost overnight. The shock traveled through every connection Lehman had built. Clients, trading partners, employees, and investors had to ask whether contracts would be honored, whether payments would arrive, and whether other banks were carrying the same hidden risks. The bankruptcy did not prove that every institution was doomed, but it made the question impossible to ignore. Lehman's bankruptcy froze confidence because no one could see the full chain of risk. Banks did not know which firms held mortgage-backed securities that had lost value, how much debt those firms carried, or whether their short-term loans would be repaid. That uncertainty changed ordinary lending into a dangerous gamble. A bank could lend money in the morning and discover by evening that the borrower was exposed to the same collapsing housing market. As trust disappeared, institutions kept cash for themselves. The problem was no longer only Lehman's losses. It was the fear that similar losses were hidden everywhere. 2 days after Lehman failed, the crisis reached AIG, one of the world's largest insurance companies. AIG was tied to many financial contracts that promised protection against losses, including losses linked to mortgage debt. If AIG failed suddenly, those promises could break across the system. On September 16, 2008, the Federal Reserve provided AIG with an emergency loan of $85 billion. The rescue showed the cost of preventing another collapse. Lehman had been allowed to enter bankruptcy, while AIG received support because its failure threatened a wider web of banks and contracts. The distinction did not calm the panic. It revealed how little room officials believed remained for another mistake. Later investigations found no single hidden act that explained everything. The chain was more direct and more damaging. Richard Fuld's growth strategy pushed Lehman deeper into risky housing assets. When those assets lost value, heavy borrowing left the firm with little protection. Repo 105 transactions made reported leverage appear lower at key moments, but they did not remove the underlying debt. When lenders demanded cash, the appearance of strength could not supply it. The lasting consequence was written into law. In 2010, the United States passed the Dodd-Frank Act, creating new rules for large financial firms and giving regulators more power to manage institutions whose collapse could threaten the whole economy. The law was an attempt to prevent private balance sheets from becoming public emergencies again, but rules could not restore everything that had been lost. In cities across the United States, the crisis brought foreclosures, closed businesses, reduced savings, and years of fear about steady work. The figures on Lehman's balance sheet became missed rent payments, delayed retirements, and families forced to leave homes they had believed they could keep. For workers inside finance, the collapse also changed the meaning of security. A respected company could disappear within days, carrying careers, pensions, and professional trust with it. Outside the towers of Wall Street, people who had never heard of Repo 105 learned that decisions made in distant offices could decide whether a local factory survived. The aftershock reached far beyond the housing market. The Financial Crisis Inquiry Commission reported in 2011 that the collapse was avoidable, pointing to failures in regulation, risk management, and corporate judgment. Lehman's record showed how borrowed money, weak oversight, and misleading appearances could turn a private business failure into a global public crisis. The most unsettling fact was not that Lehman Brothers was too large to fail. It was that, by September 2008, so many institutions were connected to the same fragile promises that one bankruptcy could make the entire financial system question who would still be standing in the morning. After September 15, 2008, the old assumption that a famous name meant safety was gone. The Financial Crisis Inquiry Commission later traced Lehman Brothers' collapse to a chain of decisions, beginning with Richard Fuld's aggressive expansion and continuing through falling mortgage values, extreme borrowing, and reliance on complex securities. Lehman's leverage left little protection when housing prices declined, while Repo 105 transactions temporarily removed as much as $50 billion from its reported balance sheet near quarter end. The commission found that this accounting treatment made the firm appear stronger than it was. The shock altered financial regulation and damaged millions of lives, as governments intervened to stop further failures while families lost jobs, savings, and homes they could no longer afford. In the end, the bankruptcy petition dated September 15, 2008, carried the weight of a global warning. Lehman listed roughly $613 billion in assets and became the largest bankruptcy in United States history, forcing investors to question the solvency of banks that had seemed untouchable only days earlier. Money market funds faced sudden withdrawals, credit markets tightened, and emergency measures followed, including the Federal Rescue Program enacted on October 3, 2008. The filing showed that a financial institution could be enormous, highly rated, and deeply connected, yet still collapse when its assets lost value, its creditors demanded repayment, and trust disappeared. Even the largest walls in finance could become empty shells.